Individual investors differ significantly in their financial circumstances, objectives, constraints, and behavioral preferences, making personalized portfolio management essential. Unlike institutional investors, individuals often have unique goals such as retirement planning, education funding, home purchases, wealth transfer, or charitable giving. Effective investment management begins with a comprehensive assessment of the investor's financial capital, human capital, income needs, liquidity requirements, time horizon, and risk tolerance. Portfolio recommendations must align with these characteristics while remaining flexible enough to adapt to changing life circumstances. Investment professionals must therefore develop a deep understanding of each client's situation before establishing appropriate asset allocation, risk management, and wealth preservation strategies that support long-term financial objectives. Risk tolerance is one of the most important considerations when managing individual portfolios. Risk tolerance consists of both risk capacity and risk perception. Risk capacity reflects the investor's objective ability to withstand financial losses based on factors such as wealth, income stability, investment horizon, and future obligations. Risk perception, in contrast, represents the investor's subjective attitude toward uncertainty and potential losses. These two dimensions may not always align. An investor may possess substantial financial resources yet remain uncomfortable with volatility, while another investor may be willing to take significant risks despite limited financial capacity. Successful portfolio construction requires balancing these factors to ensure investment strategies remain both financially appropriate and behaviorally sustainable. Investment objectives and constraints play a central role in shaping portfolio decisions. Objectives generally focus on achieving specific return requirements while maintaining an acceptable level of risk. Constraints may include liquidity needs, legal considerations, tax circumstances, unique preferences, and environmental, social, and governance (ESG) considerations. Individual investors often possess multiple goals with varying priorities and time horizons, requiring portfolio managers to develop integrated strategies that accommodate competing demands. Some investors may seek growth-oriented portfolios to maximize long-term wealth accumulation, while others prioritize capital preservation and income generation. Understanding these objectives and constraints enables investment professionals to create customized investment policy statements that guide decision-making and establish realistic expectations. Time horizon is another critical factor affecting portfolio construction for individual investors. Most individuals have multiple investment horizons corresponding to different financial goals. For example, saving for a child's education may involve an intermediate-term horizon, while retirement planning may extend several decades into the future. Longer investment horizons generally allow investors to tolerate greater short-term volatility because there is more time to recover from market downturns. Conversely, shorter horizons often necessitate more conservative asset allocations focused on preserving capital and maintaining liquidity. Because financial goals frequently evolve over time, portfolio managers must periodically reassess investment horizons and adjust strategies accordingly to ensure continued alignment with client objectives. Taxation significantly influences investment outcomes because taxes reduce the portion of returns retained by investors. Different forms of investment income, including interest income, dividends, and capital gains, may be subject to varying tax treatments depending on jurisdiction and account type. As a result, investors should evaluate after-tax rather than pre-tax returns when assessing investment opportunities. Tax-efficient portfolio management may involve selecting appropriate account structures, managing portfolio turnover, harvesting tax losses, and emphasizing investments that receive favorable tax treatment. Since taxes directly affect wealth accumulation, incorporating tax considerations into investment decisions can substantially improve long-term outcomes without necessarily increasing portfolio risk. Effective tax planning, therefore, represents an essential component of comprehensive wealth management. Inflation further complicates investment decision-making because it reduces the purchasing power of future cash flows and investment returns. Even when nominal returns appear attractive, rising prices can significantly diminish real wealth accumulation. Investors must therefore focus on achieving returns that exceed inflation over time. Inflation can affect different asset classes in distinct ways. Fixed income investments are particularly vulnerable because their cash flows are generally predetermined, while equities, real assets, and certain alternative investments may provide partial protection through revenue growth and price adjustments. Understanding the relationship between inflation and investment performance is critical for preserving purchasing power and maintaining long-term financial security across changing economic environments. The interaction between taxation and inflation creates an additional challenge commonly referred to as tax drag. Taxes are generally assessed on nominal returns rather than inflation-adjusted gains. Consequently, investors may pay taxes on returns that merely compensate for inflation without increasing real purchasing power. The negative impact of tax drag becomes more pronounced when inflation rates are high, investment returns are strong, and investment horizons are long. Because taxes reduce the amount of capital available for reinvestment, the compounding effect of taxation can substantially lower long-term wealth accumulation. Effective portfolio management, therefore, requires careful consideration of both inflation and taxation when evaluating expected investment performance and selecting appropriate asset allocation strategies. Integrating individual investor considerations with the effects of taxation and inflation is fundamental to successful wealth management. Portfolio strategies should reflect each investor's unique objectives, risk tolerance, liquidity needs, and time horizon while accounting for the erosive effects of taxes and rising prices. A well-designed investment plan balances growth opportunities with risk management, tax efficiency, and purchasing power preservation. Continuous monitoring and periodic adjustments are necessary because personal circumstances, tax regulations, and economic conditions evolve over time. For CFA candidates, understanding these concepts is essential because they form the foundation of personalized financial planning and investment policy development. Effective management of these factors enhances the probability of achieving long-term financial goals while maintaining alignment with investor preferences and constraints.